we did note technical weakening in a number of leading technology and AI stocks over the past month. Hello, I'm Justin Boyd, President of Delta Financial Advisory. Welcome to our monthly market update for September 2025. Please note, as with any of our videos, this content is intended for general informational and commentary purposes only. Nothing discussed should be interpreted or construed as personalized financial or investment advice. For a more detailed disclaimer, please refer to the conclusion of this video. If you find value from today's content, please like this video and subscribe to our channel. We don't make these videos to become YouTube influencers, but rather to connect with investors that may benefit from our investment advisory services. By liking this video, you're helping us reach a wider audience. We appreciate it. Okay, let's get started. Economic data continues to drive forward in a manner we view as supportive of a reasonably healthy economic backdrop, and certainly when viewed in nominal terms. Critical nominal inputs to the economy, such as hourly wages, retail sales, and current dollar GDP, support this stance. While our previously outlined possibility of a disinflationary window extending through the fall of this year remains, we think the risk of this window fades in the intermediate term, with each passing economic report showing increasing nominal inputs. While broader economic activity remains nominally healthy, we did note technical weakening in a number of leading technology and AI stocks over the past month. Given the potential for this weakness to build as we enter the historically volatile months of September and October, combined with persistently elevated forward price-to-earning multiples, we continue to suggest that restrained optimism in equity allocation is the most prudent course of action for all but the most aggressive portfolios. Moving on to Federal Reserve policy, Chairman Powell provided his clearest suggestion in some time that the likely path for interest rates over the medium term is downward, despite the fact that official inflation numbers remain above their stated goal of 2%. For those viewers who may be joining us for the first time, we explicitly outlined and stated in our first published video on YouTube back in November of 2024 that we viewed 3% or above as the likely intermediate term federal funds rate. At this time, this was at the high end of the Fed's own summary of economic projections and at odds with many mainstream estimates. We continue to maintain that within a free and unmanipulated market for the cost of money, an intermediate term neutral rate at or above 3% is appropriate. Given the current policy rate of 4.25% to 4.5%, this leaves plenty of room for material policy rate reductions. The likely reduction in the Federal Reserve policy rate brings us to our last keynote for this month. In our opinion, while the policy rate always remains forefront in the headlines and in most investors' minds, the continued quantitative tightening of longer-term mortgage-backed securities is creating a self-inflicted dilemma that ultimately is not in the best interest of the broader economy. In our opinion, one of the two primary reasons for the current presidential administration's pressuring of the Fed to lower rates is to support the housing market. The baseline thinking being that a reduction in the policy rate will ultimately create downward pressure throughout the yield curve and assist in housing affordability by reducing the cost of interest on mortgages. While opinions vary on the accuracy of that assumption, our research suggests that current QT of mortgage-backed securities does affect the marketplace and could be adding a full percentage point to mortgage rates. There are a variety of reasons the Federal Reserve could be continuing this policy. For example, it could be an attempt to bring down pricing on existing inventory while allowing home builders to continue to provide an overall more competitive product in the current marketplace, especially given their ability to buy down rates versus the existing home seller. A slightly more strategic narrative within the Fed could be its desire to specifically reduce housing's impact on inflation. This would keep headline inflation numbers lower in the face of steady to rising stickier price trends, buying the Fed some additional breathing room. Shown here are some of the latest metrics of inflation. What you'll notice is that the blue bar, representing headline CPI, which includes housing costs, has trended slightly down over the past year. More recently, however, this has been occurring against a backdrop of accelerating inflation excluding housing, as displayed by the green and red bars. This demonstrates a sort of inflation operation twist that the Fed could be orchestrating. The downside to this approach is that housing is such a large component of US economic activity and overall confidence that a targeted effort that reduces housing activity would ultimately be self-defeating, in our opinion. Here are a few additional things we're continuing to weigh in our investment decisions. First, we maintain our view that a higher terminal rate of inflation and higher nominal GDP relative to recent decades is likely a persistent theme across multiple investment time horizons. In other words, the economy is likely to run hot over the intermediate to longer term. Second, we continue to observe technical patterns across asset classes that suggest a convergence or more imminent timeline for potential heightened volatility. When weighed with our previous mention of notable technical weakening among some high-level technology and AI stocks, we think this combination of technical formations deserves attention, particularly when evaluated in the context of overall risk management. The third item we'd like to touch on this month is the dollar crash or foreign rejection of the dollar narrative that is so often circulated in a generally fearful manner. International flows into U.S. financial assets remain robust, particularly from foreign private investors. Simply put, people around the world still want to hold U.S. assets, as private purchases of both U.S. Treasury obligations and U.S. equities demonstrate. Our view is that the dollar may continue to experience erosion around the margin as a global reserve asset for some time, and that many of the objectives of the current presidential administration would benefit from a weaker dollar. The dollar declining to the 89 level, for example, as measured by the Dixie Index, over the course of the next few years doesn't constitute collapse. We would caution against planning with the dollar collapse thesis as a mainstay of any strategy. With that said, should tariffs remain in effect and/or the dollar decline to the 89 level, independent of tariff impacts, we would expect pressure on U.S. financial assets. Pressure, however, does not equate to a crisis or collapse of the dollar system. I'd like to now take a brief moment and touch on something we haven't really talked about before on this channel: our view of technical analysis and how we utilize it for client portfolios. We are fundamental investors here at Delta Financial Advisory, first and foremost, with a non-negotiable requirement of a strong balance sheet and strong income and cash flow statements from any individual equity we hold. With that said, running portfolios without utilizing technical analysis in today's marketplace, in our opinion, is similar to taking a road trip and not checking the weather forecast or reading the road signs. You may travel safely for a while, but eventually a critical error is going to occur that causes material downside in a position that may have been easily avoided with a thorough technical review and a more expanded timeline for entering positions. Many of our clients are particularly concerned about marginal and effective tax rates, and therefore realizing long-term capital gains while avoiding capital loss carryovers due to the small annual limit is a high priority. As we wrap up this month, a couple points we addressed last month that we think are worth repeating is that significant legislation has recently been passed, proposed, and mentioned that all provide stability or liquidity to specific markets and/or are directly net accretive to overall systemic liquidity. Additionally, we view the risk of less attractive or outright negative real rates going forward for a considerable length of time as a material possibility. Ultimately, both of these inputs are net supportive of equity pricing. Given our view that potential technical weakness is beginning to truly present itself in many large component of the indexes, and that a remaining possibility of the back end of a disinflationary window is still present, we continue to maintain mild to moderate underweight equity exposure across client risk profiles. We mentioned last month that we were allowing mild and moderate underweight exposures to run closer to full weight positioning. Some of our commodity forward equities also outperformed the index and received a boost from some high-profile headlines during August. Ultimately, we chose to take some profits at the index level to ensure robust liquidity as we enter September and October. The fixed income markets are also in an interesting position, as many key maturities in the yield curve are pushing upward to critical resistance levels, under the pressure and anticipation of a decline in rates. We continue to maintain a moderate underweight of duration relative to the most popular aggregate benchmarks. Additionally, we continue to remain open to strategic equity purchases in order to moderately reduce short-term fixed income holdings given the backdrop of a likely lower risk-free rate in the intermediate term. I hope this video provided you with a better understanding of the current economic landscape and provided insight into how we manage client portfolios here at Delta Financial Advisory. If you gained value from today's video, please click the thumbs up icon and subscribe to our channel. If you think Delta Financial Advisory may be a good fit for you or someone close to you, reach out via the contact request form at deltafinancialadvisory.com. Until next month, we wish everyone health, happiness, and successful investing.
The information and commentary contained in this video are for general informational and commentary purposes only and do not constitute financial, investment, or other professional advice. Always consult with a qualified financial advisor before making any investment decisions. Investments carry risks, including the potential loss of principal. The content is based on current market conditions and is subject to change without notice. The firm is not responsible for any errors or omissions, or for any actions taken based on this information. Past performance is not indicative of future results. This material does not constitute an offer or solicitation to buy or sell any securities.